Roblox, but it's confusing. It's for a younger demographic, like kids, gaming platform for kids. So no worries there. But there's one aspect to their deal that makes this a uniquely bad time for the online gaming platform to go public. They structured it in a way that employees would actually be the ones selling at the IPO price among the people issuing stock at the IPO price. So if it were to soar like DoorDash and Airbnb, that could hurt the morale of employees who may have sold at the lows if that were the case. In an internal memo obtained by CNBC, CEO Dave Baszucki said the company planned to work with advisors to see how they can make improvements to the pricing process work so that they will continue over the holidays and push the listing to early next year. I'm told that they're also awaiting final sign-off from the SEC, as is the company Affirm. I'm told by several sources that the buy now, pay later lender is anticipating imminent approval from the SEC and has told its advisors to ready a roadshow launch for midweek. However, those people that I spoke with believe there is a small chance that that deal actually gets done this year, given that it would require an abridged roadshow and a debut into a market with limited liquidity over Christmas week. Now, still, there is one company that is braving the markets this week, and that is the parent company of Wish, looking to raise about $1 billion through an IPO in a few days, guys.
All right, thank you very much.
Just real quickly, can you clarify what it was about the IPO at Roblox in particular? It sounded like you said that the company was concerned that employees were going to lose out because of what we've seen with DoorDash and Airbnb. I just wanted to, would you mind clarifying that point?
Sure. So we talk all the time about money left on the table, that if a company priced higher, it could have raised more and funneled that back into their business, especially when we see those big first-day pops. We talk about the opportunity cost in that way. That happens when the company is issuing primary capital or capital that's being funded, by the company's own shares. Now, in this situation, they're doing a special tender for employees at the IPO price. So that would mean that the people who are, quote unquote, leaving money on the table is not just the company itself, but also its employees. So if you're an employee and you say, okay, well, I sold my shares at X and it went up to Y, I kind of wish I had sold my shares at Y because I would have made a lot more money that way. So they kind of are, according to people close to the situation, they're rethinking the way they want to do this, given all of the price activity we saw last week, which would mean leaving not just money on the table for the company itself, but for the employees as well, which would impact morale, most likely, if they did see the kind of price activity that we saw last week.
Shepard Smith here. Thanks for watching CNBC on YouTube.